I'm Catherine Ross. I'm here live from the floor of the NYSE with Jim Cramer. Jim, what's top of mind for you this morning?
Well, ephemeral bounce. Most of the stocks I follow are already down. I think that they have to kind of retest the bad levels of Friday because the Friday run was really just driven by algorithms. So I think that happens. We're putting some money to work, fractional alerts. Talk about that in our video. But I just want to emphasize that when you get the reversal on Friday, you had all the safety stocks get clubbed. That was wrong. And we bought those. And then today you have all the cyclicals being clubbed. And that's right, because the world is going to slow and slow pretty quickly, because we're going to very quickly have a stay-at-home economy. And the analysts who recommend the cruise stocks or the gambling stocks or the restaurant stocks, I don't think they understand the way people think. Wall Street's not very good at trying to figure out the numbers when people don't gather. And that's what we have. That's what we have, Kevin.
This morning, futures were down big, and now we're up about 100 points down the Dow.
I got up. I'm changing my sleep pattern. I got up at 3, and at 3:30 they were up 65. And on Twitter, because we didn't have any site up, I said, well, this is just ridiculous. It was down 40 when I went to bed, and it gets up 600. I mean, it's just wrong. I want to urge people that there are opportunities here, but you have to just wait. You have to wait. I mean, you take a Goldman Sachs. We sold somewhat at 240. I mean, you look at it, you say, I don't want to just go in and buy it. I want to buy it at my price. Well, how do you do that? You let the algorithms take the stock down. Now, I want to make something very clear to Jimmy Chill. Wants to make something very clear, which is that I don't like markets that are up, that are driven by algos, and that's why we sold so aggressively right into that. There are people that I formerly, before I became Jimmy Chill, would have described as nitwits, who are saying, well, you like it when it goes up from algos. And those are people who, I don't know, they get up in the morning and they say, I gotta be really stupid today. Let me go be stupid. And I think that even Jimmy Chill admits that they're stupid.
So besides for changing our sleep schedules this week, can Wall Street handle another wild week?
Yeah. I mean, Wall Street can handle anything it throws at it. I just think that when you wake up, you have to say, okay, what's going to happen headline-wise? Will there be a new state? I mean, when the bear, which is, we're in a kind of a, when you're down this much as last week called a largest point decline, you got to say the bear's alive. What the bear feasts on, okay, is headlines that show there's been a new outbreak in X. I mean, we had one Rhode Island, someone who went to Italy. We have someone who went to Iran. Well, we had people come from all these countries, and obviously many of them got sick. Some of them got sick and didn't know it. That's why we don't know. We've been using this 1.4% number for lethality, but for all we know, there's millions that got this thing and didn't even know it. So I think that Wall Street can handle it. But every single time that there's a bit of news and it's negative, we're going to go down. So what you want to do is wait until we get negative news and the market and the banks don't go down or the interest rates stop going down. And that will mean that you've got a tradable bottom when we're just not really focused on bad news.
This morning over on realmoney.com, you had a column that focused on high-yield stocks.
Right. You want to do that. Something Matt Horween's, my writing partner, first identified as accidental high yielders. You have stocks that are suddenly uber competitive versus treasuries. Remember, the 10 years worth. I mean, I would never buy the 10-year. I do have a lot of cash, but that's because I can't really invest. I can do S&P, but I did want to. I'm too old to do that at this point. I don't want to put an S&P and then be down a lot. I may need the money, but this discussion more with my wife than with you. But I look at things and I don't know. I mean, I'm caught up in that high yield piece that I did. That there's oil and oil related are just bad. And a lot of that is because of the glut. I mean, it's very interesting that OPEC could very easily cut back, and the U.S. will just make up for it. A lot of what's happening in the U.S. is just revolting to me. You'll have an Apache just talk about how unbelievably good. We got hurt by this years ago, Alpine High is, and then they scrapped Alpine High. I mean, Occidental took that money, that 8% money. Oh, what a groaner. And we have way too much oil, and we'll pump it. We'll take advantage of it. So OPEC, you don't have the horses.
Taking a step back, looking at this from an investing education angle, the investors that are watching us right now, what are 3 signs that they should be in a high yield stock?
Well, I think that you want to find a stock or stocks that have great cash flow with something around 4%. I mean, you notice Merck's up today, and Merck's not there. It's a little less yield, but that's yield. Pfizer can pay that dividend no matter what because it's it makes drugs. J&J, we've been buying that. They can pay the dividend no matter what. Now that's below where I'd like it, but Verizon is terrific. We've been recommending ATT, but Verizon's at 4.5 is, to me, very, very strong. The old days, we were always worried about Verizon and its pension plan. You don't hear that anymore. So, I mean, there are a couple in there that are very good, but just not enough. And of the 10, I can only recommend a couple because I think the others are very much at sea, and I don't really want to come in and say, you know what, this is the level for IBM. Because IBM's doing a very difficult transition, and they're doing it on the fly. And I'm not worried about their dividend, but I'm worried about the principal. Remember, you got 2 components. You got whether they can pay the dividend, and then you got whether you think the stock's going to go down. And it's hard for me to imagine that 3M won't go down or IBM could still go down without any news, just because there are people who are questioning whether they can pull up the transition. I think they can, but I don't know the time. I don't know the timing. It's like I think that Google can pull up the transition to being a much more cloud services company, but I don't know the timing. They're moving very aggressively.
You can, of course, read more from Jim on realmoney.com, where you can also read about our Real Money stock of the day, GE. Now, before we talk about the Stephen Tusa note that launched GE as our stock of the day, I want to talk about the titan that built GE itself, and that's Jack Welch, who unfortunately passed away this morning. What kind of legacy did he leave behind?
I think Ken Lingard said it best. He celebrated and championed of people in a meritocracy. He believed that, and this is something I feel, and I know I was criticized on Twitter about this, but meritocracy is something I really deeply believe in, and Jack believed in that and taught us a lot about that, and I don't think that that's necessarily the prevailing theme of some of the leaders. Now, people will say, well, wait a second, that's your Trumpian. Trumpian isn't that meritocratic either. I favor meritocracy because Jack was someone who said, if you do a good job, you do well. And it's pretty simple. I like the black and whiteness of Jack. Now, there are people who moved on who I wish had gotten the top job. And then there was the guy who got the top job who was the bad part of Jack's legacy, unfortunately. But those of us who knew Jack were astounded how much he touched you and touched your life. And for me, I had come on Squawk Box the first time. I had been on Good Morning America. I was a couple times a week. I was their financial guy, and I tried to be as interesting as possible. And that was part of my endless promote for TheStreet. It was fun. I liked it. Bob Iger liked my stuff. But I got to co-host Squawk, and Jack liked me. But more importantly, the previous management came to me and said, we don't want you on because you're too much of a wild card. You frankly are not what we want in terms of business, and we don't really care for your attitude. Very, very derogatory to the point where, I was fired by Fox later in my career, and that was Roger Ailes. He's the late Roger Ailes. But when I went on and CNBC so-called fired me, I guess, Jack sent me a fax saying that I was the most entertaining guy he'd ever seen. And I took the fax and at that point I was a hedge fund manager, and I was driven over to GE, and I went to the guy who had fired me, and I said, look at this. And he said, well, I guess I have to have you on, very reluctantly. Again, I'm Jimmy Chill. There are a lot of scores that I would have settled at one time. I don't really care anymore, but it was very hurtful. And Jack just knew, well, look, I think Cramer's not going to come back, and I got to save Cramer. And there are a million stories like that by so many people. Jack championed people, and Jack was incredibly funny. He's just a really funny guy. I knew Susie from way back. Susie's fabulous. The book's fabulous. Jack's just the first book that they did together was fantastic. And he'll be missed. Now, immediately, because we're such a negative people, immediately people are saying to me in Twitter, he fired all these people and his legacy was Jeff Immelt. And he's been, look, he had to save the company. Things were different then. And now, do I like the fact that jobs were outsourced? No. Do I like the fact that the stock went from $20 billion to $400 billion? Yes. He created great wealth. And you could say, well, that wealth went away. I come back and say he created it. You can't take that away from him. And he's a kid from Salem who moved all the way up. And again, immediately people then say, well, wait a second, he dumped in the Hudson. I mean, look, we are a cynical society, and there's a belief that nobody does anything good, particularly in business. And I come back and say that Jack touched a lot of lives, he did a lot of good, and you can denigrate his legacy, but I think you're very wrong.
Now I want to take a look at GE, the current company, and that got a huge boost from a note this morning from Stephen Tusa of JP Morgan.
Stephen Tusa is a very thoughtful, considerate man who recognized that GE stock was not going to go to his target of 5. Now he raised his target to 8. You can say, well, wait a second, stock's at 11. Well, it was more. That's more symbolic. What mattered was that he said that the cash flow was much stronger than he thought. He said the cash flow was a lot due to timing. And that it was more than $2 billion miss by Tusa in terms of what they're able to do. Tusa explained very well how that may not have been I'm not saying it was ledgered man, but it wasn't necessarily the way that Tusa would have liked to see it. But the fact is that Culpus saved the company, and that's really what the piece is about. And I salute Tusa, who told you to sell it at 27. Let's not forget that. Stock went to 6. He said it's go to 5. Okay, so it went up 5 points. He saved you from 27 to all the way down, and I salute Tusa, and he thinks it does incredibly high quality work. And GE should be bought here. GE, not a Dow stock, but GE with the market coming back. GE was excellent to buy. We put some money to work this morning, but we bought a ton of GE last week.
Based on that note, do you think that GE is a comeback kid?
Yeah, I do. I mean, I follow Larry Culp very closely, and I've always thought that he was an excellent CEO, and he's a thoughtful man. He was a really good choice. He was on the board, and I think that even the Bears have to recognize, wow, he's done a good job. And that's kind of stock that can be bought. I think the retailers were bought today because those were very oversold on Friday, but that may be, other than Costco, something you have to reposition. But GE is very right. And the reason why I say reposition is that what you want to do here is you want to high grade. That's a big theme for us. You want to get out of things that you got lucky that there's a bounce. And then look at the things that have come down a lot. I mean, look at J&J. We had to get rid of Novartis. We talk about this in our action alert, but how to get rid of Novartis because it's screwed up. So get rid of Novartis, just take a couple % hit, and go high grade. And that's what we've been doing.
Now, before we go to our Action Alerts Plus Daily Rundown show right after this, let me ask you about Twitter, which apparently Elliott Management has reportedly taken $1 billion stake and is looking to oust Jack Dorsey as CEO.
I happen to like the people at Elliott very much. They do high quality work. I have said over and over again, this company needs more than a part-time. It's very hard not to be. There's only one Jack. I went to Africa. I agree with Elliott that it's good to have a hands-on CEO. And I don't know what went on with their conversation last week, but Paul Singer and his group do really high-quality work, much higher quality work than often the companies do. I feel that way by the way, about Nelson Peltz too. They just do better work than the companies. So listen to them. And I don't think they will, but at Jack should pay attention.
All right, thank you for joining us today, Jim. Guys, thanks for tuning in. We are now heading over to our Action Alerts Plus Daily Rundown show over on actionalertsplus.com. Come join us over there. I'm Captain Ross, and we'll see you tomorrow.